Hello, it's been a busy 24 hours. We've had long-awaited meetings of the Bank of Japan, the Federal Reserve last night, and as well here at Credit Suisse, an investment committee meeting. If I can just bring together the results from the Bank of Japan meeting and also from the Federal Reserve meeting, my sense overall is that central bankers are struggling, A, to understand, and B, to act in a world of low growth. They are trying more and more innovations in the case of the Bank of Japan, and also they are more and more averse to raising rates in the case of the Federal Reserve, lest they upset a carefully calibrated economy. In the case of the Bank of Japan, their latest innovation is to try and manage the shape and the stance, the tilt, if you like, of the yield curve. And this is a bit counterintuitive. Usually, the yield curve in the bond market, when it's left alone, and bond markets are not left alone these days, they are in many cases heavily owned by central banks. They tend to signal the path for future economic growth. Typically, a steep yield curve signals higher growth into the future. So the thinking of the Bank of Japan, which is to try and manage the yield curve, so keeping the short end very low and keeping the long end where it is, I think belies the sense that if they control the signal, they will control the economy. So it's somewhat maybe inverting reality. I think a worry for the Bank of Japan will be the reaction of the yen. The Bank of Japan would prefer a much weaker yen. And the initial reaction of the yen was actually to weaken, but since it has strengthened. And I think this is a concern because it suggests that markets are maybe running out of credibility for central banks. Our own view in terms of our investment strategies, we are long the yen. This 100 level is a crucial test level. The yen is not expensive, so it actually still has room to rise. Amongst Japanese assets, we prefer REITs. Actually, the property market is stabilizing in Japan compared to the riskier Japanese equities. Onto the Fed, and again, for maybe the fourth or fifth time in the year, the Fed talked a tough game before the Fed meeting and then did nothing. And there's a sense almost of Groundhog Day. This has happened over and over again, and the Fed is really, I think, is beginning to flip-flop on its own views. In her press conference, Janet Yellen was very balanced, if I can put that kindly. She referred to slowly building inflation pressures, a hot housing market, particularly in the commercial area, but also I think she belied a nervousness on the part of the FOMC members to raise rates lest they cause some kind of shock. But of course, the further they defer the rate hike or the next rate hike, the more they build up in terms of maybe financial market tension, and they also risk imbalances. I think one of the important things as well in the Fed commentary was the fact that the Fed members are really still quite uncertain as to the economic outlook. And you add all this up together, and you have a picture where a range of factors, indebtedness, low productivity, demographics, are keeping growth at low levels. And the reality is that central banks can't do very much to help these factors, but they are trying very, very hard to try with monetary policy to try and prop up growth. And of course, this is having much more of a financial market effect than an economic effect. So in terms of our own strategy, in the context of this dip in yields again, we have taken investment grade credit from overweight to neutral. The upside looks limited. Valuations and spreads have come right in. This has been a very good strategy for us. We've been overweight now for a good 5 months or so. So we take profits and bring that down to neutral. Again, in the context of what the Bank of Japan has done, we take our underperform recommendation on Japanese government bonds back to neutral. In terms of where investors should put their money, I think the slightly weaker dollar and the fact that the threat of a rate hike has now again been removed for the short term will allow emerging market assets to perform. We're overweight emerging market equities. debt and FX. And that's probably the area where we have, I think, still strong conviction. And if you look at the emerging market debt space, or even some of the emerging market equities, there is still some quite nice valuation upside compared to developed world equities. So with that in mind, we look ahead to next week. I'll just flag we have the first TV debate in the presidential campaign. That's going to be an interesting spectacle. TV has always played a big role in US politics, so I think that may be a pole shifter, and maybe markets will react. And then we have the shadow meeting of OPEC later on next week. So with the oil price carefully balanced around 45, that's also worth watching. Thank you.